So you mentioned before points and how
Yes.
first-time home buyers can sometimes not have to, go for points. Let's for those watching and listening, explain points and how they work.
Well, it's a very complex topic, but if I have to, summarize it, the market kind of price your loan based on, the down payment you're putting down, the credit score you have, and the county where you're going to buy your home, right? And based on those qualifications, the market prices your loan at, different prices. So the par rate, meaning like the $0, sometimes could be, higher. You don't really have to pay for that. But some people really want to, let's explore, getting that lower rate. So you tell them, listen, because of your credit score being this low, because you're putting only 3.5% down payment or 5% down payment, this is a 2-family home. There's many tiers that put you on a higher interest rate. For a first-time home buyer, it's easier that as well, because being that first-time home buyer allows them to put into that tier and get better rates as well. But if you're an experienced buyer as well, for example, like I was explaining to you prior, I have that amazing
When you came in today, you're over there working, and I
Yes.
said, "What are you doing?" And he said,
Yes.
"I'm locking rates over here."
Yeah,
So.
I am, because the 10-year Treasury has been moving a lot. We've been having a very nice week so far. Last week was amazing, so I was able to, lock a lot of rates. But today we've seen a little bit of an increase in the 10-year Treasury. So what I'm able to do is that I'm able to lock the day before. So what I do, I protect the loans that I know are closing very soon, because that's another thing most people don't know. Locks have a period, right? They have a 21, 30-day, 45-day, 60-day period that you have to close within that time.
What's the differentiator between getting a 21 versus a 60-day?
Price.
Okay.
Price. So the
Price
same rate
in translated into percentage rate
into the points.
into the points.
So, for example, let's say a very clear example that I have right now. It's I've been trying to price this high balance loan for like a 5.8%, and all this week it was not costing anything, but today it was costing already something, because the market's it's increasing. So what I'm able to do is price the day before. So I protect the loans that are closing very soon. So, for example, that 21 day, if I know they're going to be able to close in the 21 day, it's a easier pricer. It's a cheaper pricing for 21 days, because it's sooner. It's shorter the time that you're locking for. So it's usually cheaper. And but what I'm able to do, I protect my files that are closing very soon, and I'm able to monitor every day. And if I see any sort of increase, I just lock the day before, and we're protected.
I see.
Yeah, it's
so
awesome.
you really have to have your finger on the pulse of
you
what's
have
going
to.
on.
Yeah,
Otherwise,
just like you said.
you're out there.
You have to.
Because if you don't lock at the right time and you have an increase, I mean, it could be a substantial amount at the closing table of difference, whether you want to buy the points or whether you want to incur the increased interest rate.
Yeah, exactly.
Right?
Because sometimes, a point it's 1% of your loan amount. So if your loan amount is $900,000, 1 point will be $9,000.
Got it.
So if you're able to, save that $9,000 at the closing table, is huge for families.